Good morning and welcome to the third session of the FS Tax Conference for 2020. Thank you all for attending and apologies about the delay. We were having some technical issues. I'm Alice Kemp. I'm an employed barrister at RPC's UK Tax Office, UK Office in the Tax Disputes team, specialising in criminal tax disputes. I'm also the host of RPC's Taxing Matters podcast, a fortnightly insight into the labyrinth of tax law and tax disputes. But I am also not who you came to see today. So we have a fantastic panel of speakers today to talk us through the various aspects of tax fraud, and I'll shortly turn to the virtual podium over to them. But first, a couple of housekeeping matters. So if any of you are experiencing any issues with this platform, please do put a message into the chat box and someone will try to help you. And as advertised, this session will begin with a keynote address from Simon York, Director of the Fraud Investigation Service at HMRC, talking us through that unit and some recent developments. We're then hopefully going to hear from Eric Ferron. There is a small technical delay with him, so he may be appearing later in the broadcast than advertised. Then we'll turn it over to Michael Sallah, Donal Griffin, and George Turner. We do also have some time for Q&A scheduled in at the end. So if you do have any questions, please do put them into the Q&A box, not the chat box. I anticipate that they will get lost in there. And we will try to get to all of your questions at the end. And now, Simon, over to you.
Thanks, Alice. And hello, everybody. As Alice said, I'm Simon York, and I am Her Majesty's Revenue and Customs Chief Investigation Officer and Director of its Fraud Investigation Service. So that's the Tax Crime Enforcement Division of HMRC. So first, I'd like to thank Hansuke for inviting me to speak today. I really do welcome opportunities to speak directly, albeit virtually on this occasion, to an audience such as yourselves. So this session focuses on tax fraud, and I'm really looking forward to it, to hearing from the rest of the panel, to hearing the discussion at the end. And that's because for me, tackling tax fraud is incredibly important, not just for HMRC, but for all of us in this conference today. It's important, I believe, because of four things. It's about maintaining the integrity of the global economy, driving out fraud and inequality to make the world a fairer and a safer place to live and to do business. It's about revenue collection to fund our vital public services. Societies can't function without a robust tax base, so we need to deliver that either directly through our tax fraud interventions or indirectly by fostering an environment of voluntary compliance, an environment created in part by the deterrent effect of our enforcement efforts. It's also about building social cohesion. Fundamentally, the tax system is a contract. It's about trust. It takes us all to play and pay our part in the interests of wider society. And by tackling those who would undermine the system, we're promoting the timeless values of fairness and justice. And finally, it's about preventing harm. Tax fraud isn't a victimless crime. Societies suffer not just because of the loss of revenue to the exchequer, but because the type of person involved in serious tax fraud is often involved in or supporting a host of other illegal activity, thinks nothing of using violence, corruption, coercion. They're sometimes dangerous individuals, and we have a moral and a legal duty to stop them and the harm that they wreak. So in this session, I'm going to talk to you about the type of fraud that we face, how it's evolving, the role of professional enablers or facilitators, and the importance of taking a globally cooperative approach. But let me begin by introducing our Fraud Investigation Service, or FIS as I'll probably refer to it as we go through. So FIS operates against a background where the tax collection rate in the UK is already pretty high. So about 95% of the tax legally due is paid. In 2019-20 alone, HMRC collected £636 billion. But the challenge for my team is to tackle that missing 5%. A proportion that proportion has remained pretty static actually over recent years, although the cash values increased as the UK economy has grown. Now, chasing smugglers, chasing tax evaders has been the task of the UK's tax and customs departments for centuries. Indeed, in my London office, we have cutlasses displayed as a reminder of our history tackling smugglers along the coastlines of Wales and southern England. But my division is relatively new, and for the avoidance of doubt, doesn't use swords or weapons of any sort. We launched nearly 5 years ago, and our focus from the start was to make an ever greater impact against tax fraud, to actually reduce the amount of fraud that happens. And we do that in a range of ways, which go beyond settling or prosecuting individual cases. Where we can, we look to address the root causes of fraud and address sector-wide non-compliance. Since the launch of our fraud investigation service in 2016, we've initiated over 76,000 civil cases and more than 4,000 criminal investigations. And by doing that, we've secured and protected more than £25 billion for the UK's vital public services and secured 3,700 criminal convictions. Those are pretty big figures by any comparison. But we know that our response can't actually solely be about striving for prosecution, for example. It must consider the whole range of powers, the whole range of partners that we can harness to achieve results. So our focus is on reaching the right outcomes for the UK rather than chasing arbitrary targets for arrests or prosecutions. In terms of range, we've investigated frauds perpetrated by high-profile barristers, accountants, lawyers, investment bankers, company directors. We've tackled money launderers, tobacco smugglers, international VAT fraudsters. And we're specifically targeting the professionals who help enable others to commit tax crime, ensuring they pay the price just as firmly as those who actually commit the fraud. And for me, that last point about enablers is an important one. We're living in an increasingly connected world where the movement of money and capital is becoming significantly more fluid, and trading activity isn't constrained by physical or geographical barriers in the way it once was. We're seeing governments and businesses alike, how governments and business alike are existing within changing national and international environments, and how this is coupled with ongoing economic, social, and technological developments. We, and I think that's all of us here, are constantly having to rethink how transactions are carried out and how we ensure our systems remain equitable and effective. And while industry seeks greater innovation around fintech, around electronic money, criminals are innovating too, in particular, adapting and changing their approach to the movement of criminal funds. So as industry innovates, it's vital that it works in partnership with its anti-money laundering leads and the public authorities to identify and deny new opportunities for criminals. We've got a lot of experience actually built up over the years responding to serious organised crime and tackling multi-billion-pound frauds, experience in understanding what works when it comes to making a sustainable and a long-lasting impact against tax crime. But it's a continuing challenge, and tax fraud is becoming ever more sophisticated and ever more international in nature. This is in part, I think, a reflection of our and our global partners' success. It's not easy to commit tax fraud and get away with it. And as we've closed the net, those evaders that are left have turned to increasingly complex and diverse structures to avoid detection. They create intricate, deliberate, artificial webs using the banking system, property purchases, corporate structures, methods to obscure beneficial ownership such as trusts, powers of attorney. And with money laundering, we're seeing the mix of traditional and non-traditional domestic money laundering with international methods using foreign exchange businesses, complex structures, and transaction chains, and trade or service-based laundering approaches. So almost all of our work now has an international element, and the frauds we see are becoming more and more complex. And the recurring theme here is one of professional help, professional direction and support being an increasingly vital element of tax fraud, particularly when committed offshore. This doesn't impact solely on the world of financial services, but this realm is an important one for enablers and facilitators to access. Fraudsters require professional enablers and facilitators in order to identify or even manage the institutions that are needed to conceal and transfer wealth anonymously, to evade tax obligations, and to launder the proceeds of crime. And we've seen the role of enablers develop too, from simple intermediaries, perhaps being unwittingly complicit in the introductions and relationships they make, through being fully involved partners in supporting tax evasion to occur, to a position where they themselves are the instigators, pushing risk-taking would-be fraudsters into taking that next step. So fraudsters and evaders who in the past might have been satisfied with, say, the relative safety of a Swiss bank account are increasingly finding that they are now being forced to swim with the sharks, taking the sort of risks that were previously the domain of organized criminals and terrorists. Those trends of increasing complexity, of innovation, and a more global approach are perhaps the biggest changes that we've seen over the past decade. And these themes continue into our work to tackle organized crime. We're increasingly seeing the use and abuse of complex corporate structures to obfuscate the organized crime activity itself and to mask those top-tier criminals ultimately behind it. Alongside this, there's an increasing presence of technology as an enabler of organized crime, not just in line with wider consumer trends, for example, encryption, consumer tracking devices, but also in terms of bespoke criminal tools. Additionally, fraudsters are able to identify and exploit recently established products, for example, the disguised remuneration loan charge, or currently the COVID-19 schemes. And here too, there's an increasingly global element, with international hotspots of organized crime activity for supply chains, for financial institutions, and money flows. And this increased global nature of offending can often result in a taxpayer or a criminal residing in one location, with trusts in 2 more, bank accounts in 5 or 6 others, and corporate structures elsewhere again. For the record, let me just re-emphasize, the vast majority of professionals, or those working in the financial service sector, whose products criminals want to access, are actually a huge force for good and are important partners in the work that we do tackling fraud. So for our purposes, an enabler or a facilitator is anybody who provides a service or an action which helps somebody commit or conceal tax evasion. So very much broader than just financial services. And enablers are now becoming the focus of our investigations as opposed to simply the byproduct. And we've nearly doubled the number of criminal investigations of enablers over the last couple of years. So we currently have 200 enablers under live criminal investigation. And our focus on some of the most high-profile examples of facilitation is yielding results too. To date, our work on the Panama Papers, and we've got a speaker from the ICIJ later who led that great work. That's led to civil and criminal investigations into around 200 individuals for suspected tax offences. An important point to acknowledge, I think, is that criminals do have many advantages. They don't have to obey the rules. They can move more quickly to harness new technology than a large government department ever can. They can act in as much secrecy as they want. All of which means that if we're not careful, we can easily end up several steps behind the most sophisticated. But they're also self-interested. They're competing against each other, and they're generally wary of other crime groups. And that's where we can drive home our competitive advantage. We work closely with partners across the public and the private sector and can harness an incredible range of capabilities. And that's where we need to partner with the honest majority, working together to become a force for good. And we're doing just that. A great example is the Joint Money Laundering Investigation Task Force, or GMLIT, as a lot of you will probably know it as. So that's the UK's public-private partnership. It brings together law enforcement and the financial sector to exchange and analyse information related to money laundering and wider economic threats. It's seen many successes in developing and sharing specific threat alerts, for example. And a recent instance saw HMRC using our operational insight in conjunction with the National Crime Agency to produce an alert on supply chain fraud in the labour market. So we then worked with partners in the financial sector to boost our understanding of that risk, and an enhanced alert product was then shared with the wider financial sector via the GMLIT. Now that produced an almost immediate response, identifying a case with in excess of £15 million of assets that we believe to be the proceeds of tax fraud. So we were then quickly able to take preventive action, provisional liquidation, wiping the company out, protecting the assets, preventing further losses. Impact, which is what it's all about. One of the biggest step changes in our work to tackle those who enable or facilitate tax evasion was the introduction just over 3 years ago now of the corporate criminal offence, or CCO as we tend to refer to as. And that CCO has made it a criminal offence for an organisation to fail to prevent someone acting on their behalf from criminally facilitating tax evasion. So essentially a strict liability offence. It's about taking a different approach, not seeking to attribute the fraud to the corporation, instead focusing on the corporation's own failure to prevent its representative's criminal act of facilitation. So all large businesses now, so that's the 2,000 largest businesses in the UK, are now required to demonstrate their awareness of that CCO to HMRC via what we call the business risk review process. So that's a core feature of how HMRC manages the tax compliance of the largest businesses. And if they don't, they're automatically going to be considered high risk and attract a greater degree of scrutiny from us. Now that CCO can apply to any organisation who provides services that are used to commit tax evasion, from the traditional financial services, such as setting up offshore structures, hiding, transferring assets, concealing beneficial ownership, devising artificial arrangements to minimise UK profits, all that sort of stuff, but right through to non-financial services like storage, distribution facilities, software development. Actually, the list really is endless. As I said right at the beginning, our work's not simply about striving to increase the number of prosecutions. And with the CCO particularly, our aim is really to drive a cultural and a behavioural shift within organisations, prompting procedures to be put in place, procedures that will prevent the facilitation of tax evasion occurring in the first place. And we've already seen some clear examples of that. So tax experts in organisations linking in with their colleagues in anti-money laundering or anti-bribery and corruption to develop a more robust and more holistic approach to the economic crime threats within their business. And actually, I strongly believe that any reforms or initiatives such as this, to be successful, they can't be made in isolation or without the support of the private sector. The private sector is very much our first line of defence. It's the private sector who ultimately determine whether individuals and companies, including potential criminals, are able to access the financial system at all. They're also the entities best placed to spot suspicious activity. And both the public and the private sector spend huge amounts on tackling economic crime. The banking sector alone is estimated to spend £5 billion a year doing just that. So increasingly aligning our approaches could change the game for all of us. But just taking action in the UK alone isn't enough. I said before that almost all of our work has an international element to it. And to that end, our partnership work goes beyond the shores of the UK. So HMRC has a fiscal crime liaison officer network, so a network of about 40 officers based in key locations across the world. We're also involved in a number of the international governance groups aimed at tackling economic crime, FATF, for example, or the OECD. But one of the things I'm most proud of achieving is HMRC's role as a founding member of the Joint Chiefs of Global Tax Enforcement. That's known as the J5. And that's the group that sees us working with our counterparts in the US, Canada, and Eric is hoping to be with us here today, despite it being about 4:30 in the morning in Canada, Australia, and the Netherlands. And it's a group that's designed to combat international transnational tax crime and money laundering. And crucially, it has a specific focus on those who enable international tax crime. So what have we done in that group to date? Well, we've shared more data within the J5 in 1 year than we had done in the previous 10 years combined. We're collaborating on a significant number of investigations, some of which involve the most sophisticated international enablers of tax evasion. In January this year, you might have seen, we jointly conducted a global day of action. This worldwide coordinated activity centered around a Central American financial institution, an institution whose products and services we believe to be facilitating evasion and money laundering for customers across the globe. The institution and its intermediaries, we believe, facilitated taxpayers to hide their income and assets around the world, with suspected tax evasion and laundering to the tune of 200 million in the UK alone. So tax evasion is a global problem that needs a global response, and that's what the J5 provides. It's about transforming a fragmented international law enforcement landscape, one where criminals previously had the opportunity to slip between jurisdictional cracks, into one where each trace, trail, crumb, shadow or footprint that they leave in any one of our jurisdictions is a vulnerability that we can collectively exploit. But tax fraud remains a continuing issue for authorities across the world. It's always been this way. And while the essence of tax fraud is the same as it's always been, the form it takes has evolved. Looking back over time, there have always been periods of dramatic change, so new taxes, new products, new legislation, new systems, new methodologies. And over the last decade, the changes we've seen the mirror changes in society, so a more global, more joined up world, businesses and individuals striving for innovation, complex processes being brought into the reach for anyone to exploit. We here in the UK, I believe, have got one of the top tax enforcement teams in the world. We're leading the charge domestically and globally to tackle tax fraud, and we know we're having an impact. You don't have to look very much further than even just the last couple of weeks with some of our recent successes have announced. So the conviction of Dominic Chappelle, the arrests we've made in relation to suspected eat out to help out and furlough scheme frauds, business as usual for HMRC's fraud investigation service these days. But we can't do it alone. We fully understand as a sole tax administration, we're limited in what we can achieve in the face of the challenges we see in front of us. Our international partners in the private sector are at the forefront of this changing environment and are uniquely placed to help meet those challenges. You have a wealth of information. You have in-depth knowledge of your customers. You're able to directly identify risks and trends in your sectors. So working together and utilizing our different skills and resources will allow us to work smarter and faster and reap the benefits of that collaboration. We have, after all, a shared mission, a mission to ensure the stability and the integrity of our markets. That's vital for investment, it's vital for jobs, and most importantly, vital for our economies and our wider societies. So when I'm asked why the government is engaging the private sector in the fight against tax fraud, money laundering, and economic crime, I find it an easy question to answer. Private sector involvement is absolutely vital in any approach to combating economic crime. And when I'm asked what the role is for international collaboration, my answer comes just as readily. We just cannot tackle our shared threats without working together across international boundaries. It's clear to me that we can and must do more to tackle the issues that we face. We want to work with you, support you, to not only do the right thing, but to be a really positive force for change and integrity. But where needed, and as shown by the introduction of the CCO, we will take strong action where necessary. As our economic and technological horizons expand, it's only by working together that we can make the world a smaller place for those who would try and exploit our systems, our economies, and ultimately our societies. Thank you.
Thank you very much, Simon. Eric, we have actually managed to have joined, so I would like to pass over to Eric Ferron from the Canada Review Agency.
Hello, sorry about that. IT here gave me a problem this morning. So yes, hello, my name is Eric Ferron. I am the Director General of the Criminal Investigations Directorate at the Canada Revenue Agency. I'm also the Canadian Chief of the Joint Chiefs of Global Tax Enforcement, the J5. I'd like to begin by mentioning that although it's 4 a.m. here in Ottawa, Canada, I feel very fortunate to be invited to this panel discussion on tax fraud. Being part of a panel like this reminds you how tax fraud has become a global and complex matter that continues to challenge tax administrations around the world. Today, I'm going to take you through the CRA's mandate, our compliance efforts, and talk a little about some of our partnerships. I hope that somebody on your side has access to my presentation and can switch pages. So we're now going to slide 2 if you have it. So the CRA is responsible for the administration of tax programs as well as the delivery of economic and social benefits. It also administers certain provincial and territorial tax programs. Part of our mandate is to ensure compliance. On the civil side, the CRA selectively audits tax returns and benefit claims to ensure the fairness and integrity of our self-assessment tax system. On the criminal side, the Canada Revenue Agency's Criminal Investigations Program investigates tax evasion, fraud, and other serious violations of tax laws, and where appropriate, refers cases for criminal prosecution. So if you have access to my slide, we're now going to the third one. So the agency has over 43,000 employees throughout the country. It's divided into 4 regions. You have the Atlantic region, which is the eastern part of Canada. You have the Quebec province, you have Ontario province, and then you have the 4th region, which is the western provinces. We have corporate and program branches, and the Criminal Investigations Directorate is part of the compliance branch, which is one of our program branches. And obviously we have Justice Canada that provides us legal support. Next slide. The services and activities that the CRA conducts fall along a continuum that runs from facilitating compliance through education and outreach to enforcing compliance through a series of steps, including audits, collections, and criminal investigations. Our ongoing preference and key objective is voluntary compliance, supported by an education and outreach approach to ensure taxpayers understand their obligations and claim the right benefits and credits. But there are situations where some taxpayers may intentionally seek to avoid complying with tax laws or wrongfully claim benefits. We maintain the integrity of our self-assessment system through progressive compliance interventions. We widely use an empathetic approach when reviewing benefit claims and seek to promote compliance by helping taxpayers meet their tax obligations and reduce our reliance on audit functions for low-dollar discrepancies. We focus our efforts on those taxpayers who purposely try to circumvent paying their fair share of taxes. At the same time, we increase our consideration of penalties for repeat offenders and focus our resources on high-risk audits and significant criminal investigations. Criminal investigations are carried out to determine a penal liability and are obviously at the very end of the compliance continuum. We have to prove beyond a reasonable doubt that the offense has been committed and that the individual did so with intent. Under the Canadian income tax and excise tax laws in Canada, persons convicted of tax evasion will face fines ranging from 50% to 200% of the evaded taxes and up to 5 years of imprisonment. If convicted under the criminal code, an individual can face up to 14 years in jail. As of April of this year, we had over 330 criminal investigators across Canada throughout all 4 regions. That doesn't include management and staff that provide support for case files. In 2013, our criminal investigations program, underwent a transformation, focusing its priorities on the most egregious cases of tax evasion. These cases are large and complex and require multiple investigators per case. We now aim to have a third of our criminal cases, our criminal complex cases, involve taxes evaded over $1 million. Our last fiscal year, so between April 2019 and March 2020, the criminal investigations program executed almost 300 search warrants. We had 32 individuals that were convicted and had to pay a total of almost $3 million in fines. 13 of those were sent to jail for a total of 18 and a half years. So we communicate our results through enforcement notifications and media releases. And by communicating our enforcement activities, the CRA shows Canadians the significant consequences of individuals and corporations who do not comply with tax laws. This is nothing new. Tax administrations all over the world understand that publicly demonstrating the consequences of non-compliance encourages voluntary compliance. So next slide. So we have several partners in Canada. We have the Royal Canadian Mounted Police, for example, the RCMP, that's our national police. We have provincial and local law enforcement agencies. And we also, for example, have the Canada Border Services. Internationally, we have partners also, the OECD, and as Simon mentioned, the Joint Chiefs of Global Tax Enforcement, the J5. Canada's membership in the J5 demonstrates our commitment to combating tax crime. It's allowing us to expand our reach of tax enforcement. With increased information gathering capacities and better partnerships at its disposal, the CRA now has access to more information than ever before. The J5's focus is to bring large tax evaders and professional enablers to justice. It's truly fantastic to see our people work together to identify enablers that may be active in some of our countries. For example, you might remember back in July of 2020, the IRS announced that one of the principal operators of the Bit Club network had admitted his role in a conspiracy to offer and sell unregistered securities and tax evasion in connection with a 722 million cryptocurrency mining scheme. It was during the November 2018 crypto challenge that the Dutch Fiscal Information and Investigation Services, the FIOD, worked collaboratively with the IRS to develop leads and further develop the Bit Club case. The crypto challenge had brought together investigators, cryptocurrency experts, and data scientists from the J5 countries in a coordinated push to track down individuals perpetrating tax crimes around the world. Experts from each country gathered with the mission of optimizing data from a variety of open investigative sources available to each country, including offshore account information. I think that's a case that's a very good example of what we can do together. Global crime requires a global approach, and we're doing just that. So my last slide. As we move forward, the criminal investigations program will continue to focus on taking on bigger and more complex files involving egregious tax evaders with large amounts of taxes evaded. Egregious tax evaders are often more sophisticated, operate in a digital world without borders, which facilitate a lack of transparency of transactions and adopt an aggressive tax scheme. We will continue to strengthen and maintain our relationship with domestic and international partners. Partnerships development is key to the criminal investigation's success and evolution. And lastly, the criminal investigation program wants to increase its business intelligence. It is paramount that since cases are more complex and sophisticated. And that's it for me at this time here in Ottawa.
Thank you very much, Eric. And thank you also for your dedicated efforts to get up and be ready for 4 a.m. Turning now to Michael. Please take it away, Michael.
Thanks, Alice. And I will join Eric on this 4 a.m. call. I'm in Washington, D.C. So the nature of I landed this project with my colleagues at the International Consortium of Investigative Journalists. It was called the Fin-CEN Files. It landed in September. There have been subsequent stories like the Panama Papers. This started with a major leak of very sensitive documents. I'm sure my colleagues on this panel are familiar with suspicious activity reports that have to be filed by banks. These are highly confidential records. Nobody really wanted us to have them, but I think in the larger thing, they were critically important to share this information with the world about global banks and the trillions of dollars in dirty money that global banks move almost every day. What these records showed, first of all, what gained our interest was that some of the characters in these documents, Paul Manafort, President Trump's now disgraced campaign manager, Oleg Deripaska, the Russian oligarch, Russian crime boss Semyon Migolovich, the boss of bosses, and the notorious Ukraine oligarch Igor Kolomoisky, to name just a few. Our big banks in this world move their money all the time, despite whatever critical kind of regulations are in place to stop this money from entering into the banking system. It moves quite regularly through there. And that's what these records show more than anything else. There was only 2,100 suspicious activity reports, but they represented about $2 trillion and the largest banks in the world: HSBC, Deutsche, Standard Chartered, JP Morgan Chase. The list runs the gamut. What we found more than anything was that when banks were caught violating the Bank Secrecy Act in the US, now what is that? That was set up over the years to stop dirty money from entering into the banks. This kind of, when money goes into the banking system, it allows drug traffickers like the Sinaloa cartel, the North Valley cartel in Colombia. It allows these organizations to keep moving and to move their money and to feed their organizations. There is a human impact to money laundering. We also found in these records that these same organizations were causing death, they're causing drugs to move around the world, and as I'll explain to you soon, we found a tranche of hundreds of millions of dollars going into the American heartland, buying up steel factories and skyscrapers, basically running these factories into the ground, creating very dangerous conditions, and steel workers dying and being laid off from their jobs. So one of the important driving points of this project, this investigative series, was to show that there is a human impact to these kinds of financial crimes. They're very visceral, and that was a big part of what we want to do, be able to convey. But what we found one of the most interesting things is, even when the US government caught banks moving money for dirty criminal organizations, instead of charging them, this is for willful or wanton violations, which meet the threshold of criminality, they would not impose criminal charges. They struck with what are known as deferred prosecution agreements. So in the case of HSBC, they were caught moving $1.9 billion $800 million for the Sinaloa cartel in Mexico. This is while the same criminal organization was brutally killing campesinos, DEA agents, undercover people. They were moving their money for them and doing it with full knowledge that they were doing it. They were caught. They could have been charged criminally. Most of the Department of Justice in the U.S. pushed for criminal charges. Instead, U.S. cut a deal. It gave them a deferred prosecution agreement. And it did that for many other banks, including Standard Chartered, JP Morgan Chase. What we found in these records was that despite their promises to stop moving money for criminal organizations, they didn't stop. They continued to move the money, and the record shows very clearly. So I think part of this is the justice system for banks. How does the US government, how does the UK, how do others hold banks accountable for criminal actions? Let's take, for instance, Standard Chartered. They were caught stripping off information on transfers so that the compliance people in New York didn't see where the money was going. And where was it going? It was going to Iranian companies, some that were involved in the production of that country's missile system and its nuclear missile program. So instead of stopping the money, declining the transfers, dropping the customer, they were deliberately stripping the information off the transfer, removing it. Why? Because these banks make a lot of money. This is what it really comes down to. And so what we found was that they continued to do it. Standard Charter's deferred prosecution agreement was extended 3 times in the course of it. So what's the purpose of a DPA, a deferred prosecution agreement, if you're not going to pull the plug and charge them? There is no purpose. And so at the end of the day, I think what this project showed was that the justice system for holding the banks accountable was flawed, deeply flawed. And we would go so far as to say it allows these banks to keep moving dirty money through the system with no real consequences. So they pay a fine. HSBC pays a fine of $1.9 billion in 2012. What does that account for in their profits that year? Probably about 1/40th of what they made that year. So for them just to pay the fines is really the cost of doing business. And that's what these records showed more than anything else. We got a lot of grief from the law enforcement community and from governments about, oh, how could you let these confidential records be? You know what? The world needed to see these, and it needed to see how badly this program is really run. I'm not saying that suspicious activity reports don't play a critical role. My colleagues on this panel would certainly say no, they do. They give us critical information to move on, but not when you find the trends that we found. And let me just give you an example. So we have, and by the way, since 2010, the Department of Justice has found 17 banks willfully, wantonly, recklessly violating the Bank Secrecy Act, and not one criminal charge was filed. They were all given deferred prosecution agreements. You can't do that. You have to hold people and institutions accountable. So one of the biggest ones that we found, one of the cases we found that shows the real human impact, Igor Kolomoisky is a very controversial, powerful oligarch in Ukraine. He managed, according to U.S. prosecutors and Ukraine regulators, he looted Privat Bank, a bank that he founded, of hundreds of millions of dollars, and moved about $750 million with the help of Deutsche Bank into the United States. Now, Deutsche has been fined over the years. It's been charged. It's been caught. Most recently, it paid a fine because it was moving money for sex offender Jeffrey Epstein. Deutsche Bank moved this money through shell companies. Most of it went through the British Virgin Islands, and then it came to Delaware, where they were creating these Delaware shell companies where there is no disclosure on ownership. They went on then to buy major steel factories. And instead of going to Miami and New York, where most criminal entities go these days, they go into the heartland of America. They go into friggin' Cleveland, and they go into West Virginia and Indiana, places like that. And they started buying steel factories, basically to launder the money. Most of these places, they ran into the ground. We found numerous OSHA violations. That's the federal regulatory agency that looks for safety. And steel workers not only died, but also were injured. And eventually, we look at a place like Warren Steel in Ohio. There were so many environmental crimes that were committed there that they're still dealing with dirty, toxic chemicals flowing into the Mahoning River. So they left behind empty buildings, unpaid taxes. They left behind jobless workers, injured workers. So there's a real human cost to this. I think that's what we eventually showed through this project. It's had two really good results. The UK the Parliament Treasury Committee did launch an inquiry, and then also the Congress has in the US looks like it's going to pass legislation that would require LLCs, LLPs, these shell companies to disclose ultimate beneficiary owners. So I would encourage anyone to go online and look at ICIJ's Fin-CEN files investigation. It did it in consultation with BuzzFeed News. BuzzFeed got the original leak. ICIJ is really the organization that carried this through and held it up through multiple installments. So I'd encourage anyone to look at it, and thank you for your time.
Thank you very much, Michael. Turning now to Donal.
Hi, folks. Can everyone hear me okay? Yeah, great. Yeah, thanks a million for having me onto this panel, and that was pretty devastating summary of the financial system from Michael. Thanks a million for that. My name is Donal Griffin. I'm a finance reporter with Bloomberg News here in London. I've been here in London for about 5 years, spent about 3.5 years, 4 years or so covering Wall Street with Bloomberg before that. So I have spent an unfortunate amount of my life writing about investment banks and hedge funds and investment funds and all sorts of finance, really. One of the things that I've been looking at for the past 18 months, really, is the Cum-ex affair, or the Cum-ex scandal, or whatever you want to call it. This is, I think, one person described it to me as the biggest tax fraud you've never heard of, which I think is a nice way of kind of summing it up. I'll try to be really brief and succinct in my kind of description of it. In short, this was Cum-ex, which is a Latin term, was a trading strategy that kind of developed in the city, as far as we can tell, on sort of trading desks of, European, US, Australian investment banks. It's quite complicated, extremely complicated, but the upshot is that multiple parties were able to claim tax refunds on a single batch of dividends that were paid. So you have multiple parties making reclaims for one batch of tax that got paid, which sounds quite boring on its face, but when you realize the scale of it, as it played out, let's say starting in the mid-2000s, maybe before that, went on in jurisdictions like Germany, Denmark, Belgium, the Netherlands, all over continental Europe. The Germans now claim figure, I'm not exactly sure where this figure came from, but the figure that does the rounds in Germany is that they lost about 10 billion euros of tax revenue. Sorry, they paid out 10 billion euros in refunds that they now claim were illicit. Denmark is pursuing just one case that amounts to about 2 billion euros, which is, I think, about 1% of the country's GDP. So I guess that's the scale of it, and that's probably the reason we should care. Depending on who you talk to, Cum-ex was either like a clever and entirely legal use of loopholes in the tax laws of various European countries, or it was an outright scam. The explanations of what it was tend to kind of run that gamut of explanations. There's still a sizable population out there who believe that this was, again, clever and entirely legal. Many other people believe that it was a sort of a sophisticated, coordinated tax scam. And again, I think what's really interesting here, following on perhaps from some of the things that Michael was saying, who was involved here. I'll try and stick a few of the stories that we've written about this over the past 12 months or so. According to sort of testimony of of people who were involved in the industry, Cum-ex was widespread across the financial industry. It couldn't have worked without, most of the biggest players in international finance, range from Barclays, Bank of America, Merrill Lynch, Morgan Stanley, Deutsche Bank. Just this morning, my colleagues published a story on ICAP and the interdealer broker. I'll try and pop it in the chat here. Hopefully that works. There it is, I think. Now, and I suppose the reason why we're spending so much time reporting on this now is that it seems like authorities around Europe are beginning to step up their investigations into this. There was a sort of a landmark trial involving two former Cum-ex traders that went ahead in Germany. It wound up with guilty verdicts earlier this year. I think a lot of people in the Cum-ex industry had hoped that would be the end of it, but I think they were mistaken based on the stuff that we've reported. If anything, authorities seem to have stepped up their investigations since then. There's a series of cases against alleged former Cum-ex traders making their ways through sort of various courts in Germany and Denmark. Like I said, we recently reported at Bloomberg that in the UK, the FCA is now probing about 14 firms, 6 people in Cum-ex cases. We've also seen escalations of sorts in Austria and Luxembourg. So exactly where this is all going to go across all of those different jurisdictions, how far it's going to go, how extensive these investigations are going to be, and ultimately what the penalties are for the financial institutions that were involved. Obviously, journalist cliche, but that remains to be seen. I think one of the things that always stands out to me as a reporter covering this is, again, I think similar to some of the things that Michael was saying. I suppose what's always so interesting is just the approach to tax among some of the most sophisticated institutions in the financial services industry. As someone who's not, I mean, I'm a reporter. I'm not a tax. I don't work in tax advice. I've never worked in finance, so I suppose I've got a bit of a layman's approach to tax, which is that you pay your tax bills, whereas what seems to emerge from all of this reporting that we've done on Cum-ex, and also, I beg your pardon, there's a number of other media organizations have done superb work on Cum-ex as well. Before I forget, the idea that tax is something that is there to be arbitraged and something that is there to be a potential profit center, I think that's something that says a hell of a lot about what the culture was in financial institutions, certainly back then. How that's changed now, I guess I'll let people who work for financial institutions answer that question. But that's certainly one of the most revealing elements of the Cum-ex affair for me and for my colleagues, which is just, again, I don't wish to echo Michael too much, but it does seem to be a cultural issue, that if a trading strategy is profitable, and if you can get enough lawyers to sign off on it, to Simon's point about enablers and advisors and so on, that if a certain trading strategy is profitable, and if you can get enough people to sign off on it, no matter the moral or ethical implications, if it's just about doable legally, then go for it. That seems to have been the approach of a number of institutions back then. So we will have to see how that all plays out. But I guess that is, I hope I probably rushed through that a small bit. I'm just trying to keep to my 10 minutes, but I hope I've kind of summarized as much as I can of what the Cum-ex affair is. I'll pop a few more stories into the chat now as we move on to the next speaker. But yeah, I think that's all I've got to say on it for the moment, if that's all right.
Thank you, Donal. And if anyone does have any questions or wants to Donal to expand on any part of that, please do just put them in the Q&A and we'll see if we have time to come back to them. Turning now to George.
Hi. Well, thanks so much for inviting me. It's been super interesting and privileged to be on such a panel with such fantastic speakers. And Michael and Donal give us some powerful examples of fraud and money laundering being exposed by investigative journalism. Much of the focus for investigative journalism in the last 10 years has actually been on the subject of avoidance. If we think of a lot of the big kind of leaks that we've had, LuxLeaks and the Panama Papers and so on. And it's an article of faith held by many journalists, politicians, and society more widely that there's a clear dividing line, that tax avoidance is legal, whereas tax evasion is illegal. And this faith has developed for a number of reasons. For journalists, the idea that tax avoidance is legal can provide a convenient defense against libel. Now, how can someone be defamed for being accused of doing something perfectly legal? A tax avoidance industry that makes billions of dollars a year selling and marketing tax avoidance schemes around the world wouldn't make nearly as much money telling people that their schemes were potentially criminal. However, without wanting to cast aspersions on the concept of faith more generally, I think this particular faith is a fiction. In English law, tax evasion is most often prosecuted under the common law offence of cheating the revenue, where the potential liability is positively draconian compared to what we heard from Eric earlier about the criminal code in Canada. Cheating carries a maximum penalty of life imprisonment with an unlimited fine, although normally people don't get life imprisonment for a conviction. It's defined by the Oxford Dictionary of Law Enforcement as to make a false statement relating to tax with intent to defraud the Crown, or to deliver or cause to be delivered a false document relating to tax with similar intent. There's no requirement for the offence to be committed by the taxpayer. It can be committed by anyone who advises the taxpayer or assists in the preparation of a return, i.e. an accountant or a lawyer. There's no requirement for concealment or deception. The conspirators can be open about what they're doing. There's not even a requirement for the revenue to demonstrate they've suffered any actual loss. As set out by the leading textbook on English criminal law, it's difficult to see how the offence could be stated in more expansive terms. The offence is, of course, even broader when charged as a conspiracy, which it often is. So what this means is the only real live issue is often whether the tax position being claimed is honest. And well, what's honest in the legal sense is quite simply, it's not being honest. And it's judged by the standards of ordinary people. This is an important point. Now, up until recently, the courts believed that in order to be convicted of a crime of dishonesty, the prosecution had to prove that the person committing the crime knew that they were being dishonest, and now that's no longer a requirement, for the obvious reason that the more dishonest someone is, the harder it would be to convict them. As was put succinctly by Lord Nichols, honesty is not an optional scale with higher or lower values according to the moral standards of each individual. Now let's consider for a moment the design and promotion of tax avoidance schemes and what that means in practice. Tax avoidance, as understood by tax law, is where a real economic transaction is made to appear to be something else in order to create a loss for the revenue, a gain for the taxpayer, and a healthy fee for the scheme operator. It often involves a set of contrived or artificial transactions with no real business purpose, which means that the transactions do not provide an honest representation of the real economic position of the person or the company involved. In corporate taxation, this can often mean things like paying royalties and management fees to shell companies that employ no staff or have no discernible operations. For individuals, that means the creation of fake investment losses which are written off against the tax liability but are in fact never really suffered. Given widespread and targeted anti-avoidance rules, schemes often require an element of concealment, and that's why accountants and lawyers fight so hard to keep their advice from entering the public domain or from being disclosed to tax authorities. Now, putting this all together, we can see that many, and in my opinion, the majority of tax avoidance schemes could easily fall foul of the law on cheating. And where there's been an active attempt to conceal the scheme or a failure to disclose information regarding to the scheme deliberately, that is clearly fraud. And given whether this ultimate judge of whether a scheme is dishonest or not is a group of randomly selected members of the public, and the total disdain which the public view tax avoidance at the moment, I think that many tax avoidance schemes, if put before a jury, would be found to be dishonest and therefore criminal. Now, in the past, the UK has prosecuted barristers and accountants for operating tax avoidance schemes, although I'd say such examples are relatively few and far between. We heard from Michael earlier about the issues with DPAs in the US. In the US, the IRS has done what the UK has never done to my knowledge and prosecuted Big Four accountancy firms for their role in designing and selling tax shelters, which is the US term for a tax avoidance scheme, to high net worth individuals. Previous head of HMRC, Dave Hartnett, once famously told a journalist that the reason why HMRC did not prosecute as many cases of tax fraud in the advisory profession compared to the US was simply because advisors in the US were in the UK were more honest than their American counterparts. Make of that what you will. But the simple fact is that there's no requirement in the UK, and I think elsewhere, to prosecute fraud as a criminal offence, tax fraud as a criminal offence. Tax authorities can instead seek to claim back any taxes lost through the civil legal process. In many cases, these civil cases don't even come to court, with the taxpayer settling. Indeed, there's no requirement on tax authorities to plead fraud at all, with many cases involving clearly fraudulent schemes being considered under anti-tax avoidance laws, with no specific allegations of fraud being made out. Now, this approach can clearly have advantages for tax authorities that are focused on revenue raising. However, it is an approach, in my view, that encourages avoidance and perpetuates this myth that tax avoidance is legal. It's also, I think it has to be said, HMRC's stated policy that they will not prosecute most cases of tax fraud as a criminal offence, instead having a preference to pursue civil claims. This is clearly stated in HMRC's criminal investigation policy, which states the following. It is HMRC's policy to deal with fraud by the use of cost-effective civil fraud investigation procedures, wherever appropriate. Criminal investigation will be reserved for cases where the HMRC needs to send a strong deterrent message, or where the conduct involved is such that only a criminal sanction is appropriate. This does sometimes, and I think what Simon's statistics he gave earlier kind of bear this out a bit, with the balance of civil cases against criminal prosecutions in fraud. It does sometimes leave some bizarre outcomes. In one case this year, Lindsay Hackett versus HMRC, HMRC was seeking a £13 million fine from an individual involved in a fraudulent VAT scheme. The individual in question sought to claim that it was abuse of process not to try them in a criminal court, where they would have had greater procedural protections, effectively inviting HMRC, please try me in the criminal courts. And as the judge in the case knows at the time, it's not often that someone expresses a preference for a criminal trial. Another good example of the policy in action is provided this week in the front page of the Financial Times, declaring a new crackdown on corporate tax avoidance. This related to a disclosure facility regarding a corporate profit shifting. The disclosure facility was prompted by a series of investigations into large multinational companies operating in the UK. And if you look at what HMRC has said about those investigations, they say that HMRC has found some multinational enterprises have adopted cross-border pricing arrangements that are based on an incorrect fact pattern. Well, what does that mean in the Queen's English? I mean, it sounds like alternative facts. It goes on to say that some have made incorrect assumptions or not implemented arrangements as originally intended or declared to HMRC. So there is a divergence between the fact pattern on which the transfer pricing analysis is based and what is actually happening on the ground. This could be for a variety of reasons, including incorrect or misleading statements on the nature of relative functions, assets, and risks at the outset. Now, the behaviors being described in this clearly point towards fraud, But in this case, there's not even a civil fraud investigation going on. All that's being asked is for large businesses to make a voluntary disclosure to resolve the matter. Now, to wrap up, I don't think this approach is going to be sustainable in the future, partly because there's going to be institutions like TaxWatch, which is going to be pressuring the government to take a stronger approach towards tax fraud. But I also think the public are increasingly losing their patience with this approach. And I think as we move into next year, we move past the corona crisis, and there will be the inevitable conversation about who is going to pay for the vast amounts of government spending that have taken place over the last 6 months. There will be very little tolerance for people who are seen to be being committed tax fraud to be getting off with anything other than a criminal prosecution. And there is also inevitably going to be more tax stories in the press. There always is, right? You know, we've had 10 years of Panama Papers, Paradise Papers. Even before that, we had BVI leaks, Swiss leaks. We had Google and Starbucks stories coming out more than 10 years ago. So I would be flabbergasted if the investigative journalism industry is now done with tax, and no more stories are going to be come out over the future years. So that really concludes my remarks on that. I think you know, tax fraud and tax avoidance is a much blurrier line than many people make out, and many of these stories are showing that. And I think it will be an interesting development how that plays out in terms of enforcement over the next 6 months to a year and beyond that.
Thank you very much, George. Now, obviously, that did raise a number of questions for HMRC, and Simon, you're here. Do you want to respond to any of George's questions?
Yes, please. Actually, I mean, great stuff, George. Really interesting. A lot of what you said really resonates, I think, with me. But you did there attribute a number of sort of motivations and or a situation we'll see. So, given I'm here, I think I'll put our side of that story. I guess so. Let's just step back firstly and talk about our overall strategy. Yes, we do way more civil interventions than criminal in HMRC. We think that's right. We think that's proportionate for the majority of situations. Lots of sort of tax evasion is really small scale stuff. The courts would just fall over if we viewed everything that was theoretically capable of being prosecuted. We're already waiting, you know, quite significant lengths of time to get cases into the criminal court. Our strategy of using criminal investigations, there's three things we look for. One, it's either the severity, so the size of it, or the person doing it, or whether it sort of demands a criminal sanction. You mentioned there the deterrent impact, so something that will really resonate with a group of taxpayers or the public at large. You know, we don't want to get caught doing that or whatever. And then just where civil won't work, and that's sometimes where your organised crime sort of side of things, civil intervention just won't cut the mustard there. So that's the overall position. Avoidance and evasion. I note your legal analysis of that. I wouldn't completely go along with every step of that. So I think the distinction between avoidance and evasion legally and sort of theoretically, if you like, is crystal clear, really. And the key is that misrepresentation, that deliberate lying or false documents or whatever, which pushes things into the evasion side of things. But you're right, practically, the difference isn't always as easy to spot. But if we see cases that are perhaps presented or marketed as avoidance, but when you get underneath the facts, there is misrepresentation happening. And you gave one example of something we've seen over recent years, where, for example, an important part of the scheme is spending cash on something that qualifies for relief, a film or environmental research or whatever, and it hasn't been. It's gone into someone's Swiss bank account, or that something's supposed to have happened, some financing, and it hasn't. It's just been a circular overnight back and forwards. Then we will go down the prosecution. And you might be surprised, actually, George. So since 2016, when we created FIS, we have had 20 people convicted of frauds in this situation where they've been marketing schemes as avoidance. Those 20 people go 100 years of custodial sentences. It's actually one of the types of case where we get the longest custodial sentences. There's a case in 2018, biggest tax fraud I think the UK's ever seen. The guy's got 11 years. The main guys there. And in the last year alone, we've arrested 9 people on suspicion of promoting fraudulent arrangements to get around the loan charge. So we're still really active in terms of the current avoidance schemes, as well as the previous sort of generation that have only really just been coming into the criminal courts over the last few years. So actually, it'd be really great to pick up this conversation, probably offline at some point. But I can assure you and people watching that we do take this seriously. We are actively investigating. We're using all the powers and techniques at our disposal to get behind this. And where we see things that cross the boundary, where people have gone beyond just putting all the cards on the table and telling the truth, then we won't hesitate to go down the criminal route. And when we go down the criminal route, we win 9 out of 10 cases at trial. And that's going some. That case I mentioned in 2018, 10 months before a jury. Incredibly complex, which is another issue about how, which cases do you take to court? We don't take everyone. Some you just, you've got to make a decision on, will we be able to bring this home or not? Incredible use of public funds. So we need to be really certain with that. So that's a bit of an HMRC perspective. But agree with an awful lot you said, George, and certainly in spirit. And I can assure you we are seeking to go down the route where we can.
Thank you, Simon. So just one of the questions which has sort of arisen is, obviously we are all doing this conference via a virtual platform, which does have the spectre of COVID sitting behind it. So in particular, Simon and Eric, has the nature of the COVID pandemic changed the way in which tax fraud has been investigated?
Sorry, I'll let Eric come in a moment because I've spoken a bit, but yes and no. HMRC has been right at the centre of all the COVID stuff, hasn't it? So we had to sort of design schemes and implement schemes and pay money out to people, and that's been really at the forefront of what we've been trying to do. But what we did make a decision very early on was to protect our serious fraud and counter organised crime capabilities. So we've continued doing that all the way through. Now it's been more difficult at times. Like other people, we had to get all the PPE at the beginning. We've had to use different sort of approaches, or when dealing directly with customers. Surveillance wasn't so easy in lockdown when there was no one on the streets. So it has affected us, but we've broadly continued going. I alluded earlier to the courts. It's more difficult to get cases into court. The sort of length of time is going, but broadly we've kept going. And as I alluded to, we've already made a series of arrests in relation to people that we think have been trying to abuse some of the schemes that are there meant to help UK citizens. So that's how it's affected us.
So for Canada, obviously we're in the same situation as the rest of the world, where we're the revenue agencies trying to roll out all these benefits to people to help them in these unprecedented times. Obviously, the challenge to make sure it doesn't get into the hands of the bad actors. So for us on the criminal side, our activities have continued during the pandemic to make sure that the money was going to the right places. We need to do this, obviously, in a different way. We need to make sure that our staff was safe and could continue working in a safe way. So our employees have been given the tools to work remotely. But it's been more difficult, obviously, to get search warrants, for example. You have to respect certain social distancing rules. Going to court, the courts have slowed down as proceedings have been postponed or either canceled. Traveling for investigations was very limited. Canada's a very large geographically country. So a lot of our interviews in different cities or searches some of them had to be postponed. So yes, there has been an impact, obviously, but we're still working. And as we get used to the pandemic, I guess we are getting better at working in it. And we have resumed doing searches. It's just we have to obviously make sure our staff is secure and doing it in the right way.
Thank you, Eric. There's been a question about, probably more for Michael, Donal and George, there's been a question about the views on public disclosure of tax reporting and whether or not that would be, in your view, of benefit.
Shall I go first?
Go ahead, George.
Yeah. Well, I mean, tax transparency has been a big goal for many campaigners for a number of years, and we've had certain initiatives which have hugely increased transparency, but only to tax authorities. So you have things like the Common Reporting Standard and the country-by-country reporting by multinationals, which is only going to tax authorities. And I think the big criticism is that tax authorities do a fantastic job, and I don't want to take away anything from what Eric and Simon's doing, but there also needs to be wider accountability. And journalists can raise issues and up the agenda, and there's obviously been political reaction to many of the tax stories that have come out, and so greater transparency for the wider public and for those people is very important too. So I don't think it's good enough in many cases to have transparency just between tax authorities. There needs to be a much better effort at getting a public transparency about the tax system.
Yeah, George, just piggybacking off of that, as you know, we in the U.S. have been trying to get President Trump's tax returns for quite some time. It's been difficult, and there's consequences to that. And I think the public, in the case of a president, the public, we believe, should know what his taxes are, what his disclosures are, because there's national security implications, there's leadership questions that can be certainly raised. And so it is a balancing act between the whole idea of privacy versus at what level does it rise to where the public should know some of these different tax filings dealing with certain individuals. And so I think that it's something that we continue to press for from the journalism ranks, and we certainly respect or certainly understand the privacy provisions. In the case of the president, my guess is that much more is going to come out after he leaves office, and I believe that the regulators in New York and the and Cy Vance and others will probably see this through much more thoroughly in time to come.
Donal, anything to add on that?
Sure. I mean, obviously, I think George and Michael are the experts on this one. I mean, but I guess generally speaking, perhaps not specifically referring to the Cum-ex stuff that I was talking about earlier, but I mean, the investment banks and the financial institutions that we cover, like a decade since the financial crisis, they remain, pretty opaque institutions. And I think most investors in those institutions are okay with that. They only have to disclose so much about how they make their money. And certainly that's one of the things that we have found while reporting out on Cum-ex. You go back to, like, one of the banks that we looked at, for example, was Macquarie, which has been heavily involved in Cum-ex investigations. We did a pretty big piece on that, I think, in December. We zeroed in on the one particular banker who had introduced Cum-ex to Macquarie around 2005, 2006, and it all went from there. But we went back and kind of looked over their annual reports for 2007, 2008, 2009, as revenue from this trading strategy was starting to come in. There was a one throwaway reference to, I think it was, synthetic equity finance or something like that in 2008, having gone up, I can't remember the exact percentage, but it went up a lot, and it was now driving revenue. So I guess as a journalist, I would always like more disclosure. I don't think it's going to happen in the world of investment banks, again, because I think regulators are okay with what they get specifically from financial institutions. Shareholders and investors are okay with the level of opacity that's there. So I don't think investment banks are going to turn around tomorrow and say, hey, we made 10 billion quid from trading last year and we're going to break it down line by line by line. I don't think that's going to happen anytime soon. Would it be a good thing for people like me and Michael and George? Oh yeah, absolutely. But and by extension, the people who read our articles and learn about how these institutions work, would it be good? Absolutely. But is it going to happen? I would be surprised.
No, and I'd agree with that, Donal. I mean, you could possibly make cases for things like politicians or certain very big financial institutions, but to take the step to publicize everybody's tax position would be a huge step for the UK in terms of the privacy of citizens. I mean, I think there's at least one Scandinavian country has gone down that route, where there's like a public register that you can get details of your neighbour's income on and that sort of thing. But also from a tax authority's point of view, we get quite a lot of benefit from people feeling confident they can share things with us. We want the truth from people, and most people do tell us the truth, and often will tell us the truth where they won't tell the partner the truth or their business associate the truth, because they know that we won't reveal that, and that their tax affairs are completely confidential, which is pretty much the position across the whole world.
There was a famous case of a burglar in Australia who declared his hammer and chisel as on his self-assessment tax return because he wanted to deduct them as a cost from his income. And he did that knowing that the privacy laws would prevent the Australian Tax Office from telling the police about it, although I'm not sure that would be the case anymore.
Now, there have been also a number of questions, just sort of shifting focus slightly, about the potential for a corporate criminal offence of just financial crime. And that's obviously something that's being discussed a lot in the UK at the moment in particular. But is this something that anyone, George, Simon, have particular views on? Would this help with tax fraud?
So, I mean, my view is it wouldn't help with tax fraud because we've got what we need. We have already got the failure to prevent for tax, and the UK's got equivalent legislation for bribery. What we haven't got is a broader offence for wider economic crime as a whole, and I think that's the discussion at the moment on the Law Commission looking at that currently, and the debate will be around the cost to industry, cost to business against the potential advantages. But from a tax perspective, I think we've got what we need in terms of the corporate criminal offence that I talked about earlier.
In Canada, we also have provisions in the income tax and our tax laws that put corporate liability on the officers, directors and agents who direct or authorize or request in the participation of an offence. So a certain level of knowledge is required, obviously, similar to what the UK has. And the provision does give rise to a defense of due diligence, but we do have something in the legislation.
I think one thing that isn't done, which wouldn't require any change in the law, I mean, as I set out in my piece, I think the law in the UK at least is extremely broad in its potential application. The problem with corporates has always been this idea of the controlling mind of the corporate, which is what the corporate criminal offence of tax was trying to deal with. But there doesn't seem to be that much of an attempt to prosecute individuals working within corporates for the schemes that their corporates may or may not have been involved in. I mean, there's a really interesting case going on at the moment with General Electric in the UK, which we wrote about in the summer, where HMRC are alleging fraud in relation to a contract dispute about the way that the clearance system worked, but not alleging it in any criminal way. You know, they're limiting it to that particular issue rather than pursuing the criminal aspect and potentially trying to get people who are actually not disclosing the stuff at the time. And you know, obviously people can't talk about cases, so it's unfair because I can. But you know, there are a number of cases where tax avoidance schemes have been run by major institutions, and I think it would be an interesting approach to look at whether there is potential for liability for people working within the institutions for acts they have done, maybe with knowledge of the institution, maybe without knowledge of the institution.
So, I mean, yes and no, George. I mean, going back again, there is no, this is where we sort of slightly disagree, there is no criminal offence of tax avoidance or promoting tax avoidance. So if it's genuinely tax avoidance, then no, we wouldn't do that. However, we would, and we do, and we currently have live investigations involving some very large corporates where individuals within those companies have lied to us in the context of a discussion. So let's say a large organization is talking to us about transfer pricing, and that's you know, it's going along as a typical sort of civil tax discussion, and but then within that there's some false documents provided or some lies told. Then absolutely we would go down the criminal route there in relation to those individuals, however senior they are. But as you say, proving fraud by a corporate before we had the corporate criminal offence is really difficult because you've got to show that controlling mark. That's almost practically impossible when you get very, very large corporates. But the corporate criminal offence, as I would just re-emphasise, that makes it pretty easy actually, because it's strict liability. The board does not have to have any consciousness or played any part in that fraud other than of having failed to prevent its representatives facilitating it. So that's the real game changer here.
There's also been a question about, Michael raised the question of deferred prosecution agreements and how that system operates within the US. Obviously that scheme has now, well, that ability has now been given to the UK, but hasn't as yet been used in tax investigations by HMRC. Is there a thought of developing that and moving into that deferred prosecution scheme?
So potentially, as we get further with corporate criminal offence. So corporate criminal offence only came in September, October 17, wasn't it? So the actual offence needed to have taken place after that point. Then we need to identify, then we need to investigate it. So we're not at the stage of getting cases before the courts yet, but we've got about, I think, 30 cases where either in live criminal investigations or looking at seriously at the moment with that. So they will come through. Some of those might be appropriate for deferred prosecution agreements at some point. And you know, I take the point being made about all of those agreements, but equally they can be a useful tool. You know, you don't send a corporate to prison anyway, so it is about a fine and the reputational hit. And a deferred prosecution agreement can be really useful. And I know the Americans use this on their sort of Swiss bank program in terms of building in future disclosure of information. So they can be a useful tool, but at very early days for us, I would get to be probably limited numbers.
And the sort of wrap-up question is, we've heard a lot about the sort of the Fin-CEN and the Cum-ex, and is anything changing to prevent issues such as those arising in the future? What are your views?
Well, I'll go first. Sorry, Michael.
No, go.
Specifically on Cum-ex, let me see, how do I answer this one? Okay, specifically on Cum-ex, a lot of the supposed loopholes, again, depending on who you talk to, some people say that these were legal loopholes that were, you know, properly, cleverly exploited. Other people say they weren't really loopholes at all. One way or another, jurisdictions across Europe have moved to, you know, close off the avenues that enabled the likes of Cum-ex. I think, if from memory, I think ESMA, the European markets regulator, published a study a couple of months ago kind of recommending, I hope I get this right now, but recommending that I think tax authorities and financial regulators in each country spend more time talking to each other about sort of tax avoidance trading schemes, which came as a bit of a surprise to me. I kind of presumed that they talked already, but anyway, there you go. That was one recommendation that ESMA made as well, that there be more discussion, more coordination, not just between different jurisdictions, but even within jurisdictions. So in terms of something as sizable as Cum-ex, I think a lot of the avenues that enabled that have been closed off. But there are still ongoing versions of, I think it's, the jargon is dividend arbitrage, and there are a number of dividend arbitrage schemes that continue across Europe. I mean, it's nowhere near the scale of Cum-ex, but it continues, have no doubt. It's something that we're always looking into. It's something that we're always looking to write about. So something like Cum-ex in and of itself won't happen again, I don't think. I don't think it can. Certainly not with the jurisdictions that have been involved. But will something like it? Is something like it happening on a kind of a smaller scale? Yeah, absolutely. Which raises, I suppose, questions again about, I guess, just the approach to taxation and how people view it. I'll finish up now, but I mean, we did a story last year. It was the story that kind of piqued my interest on the world of dividend arbitrage and tax schemes. We did a big piece on Barclays, the UK bank, and a desk at Barclays that was making quite a lot of money from what I'm sure is, again, perfectly legal, signed off, approved, etc., trading scheme where they made a couple of £100 million a year from avoiding dividend taxes through various jurisdictions, and they had an entity in Luxembourg that they used, and so on. And again, I'm sure it was all perfectly legal, unlike something like Cum-ex, which a lot of people say was not. But that, to me, suggests that, again, that attitude and approach towards tax, for better or for worse, is still there. And as long as that's still there, you will continue to see things like this pop up. That was a long answer, but there you go.
Thank you, Donal. I think we are about to run out of time, so if anyone wants to have any quick other points that they think should be raised there. Michael, you seem like you had a comment to say.
Well, I was just going to say, I think that within here in the Congress, Republicans and Democrats don't agree on a lot of things. But the one thing they agree on is that it would be wise to start using the tools of criminal prosecution in much more effectively, because obviously a lot of the deals that were cut over the last 10 years in the wake of the financial crisis just didn't work, and it didn't drive the point home. There was a time, as George brought out, where we did jail the big accounting firms when Enron and those other implosions took place. But those have gone by the wayside. So I think what you're seeing from both the Dems and the Republicans is an effort now to really make a good faith effort to impose criminal penalties where they can be imposed. And maybe not, the use of DPAs is really smart. They work in many cases, but there's been an overuse of them in the last few years, and I think most people have agreed to that.
Yeah, no. I mean, I think that's the point, is how, exactly that, and how to smartly manage this. And I think, what Simon said earlier about starting investigations about people who had lied in the process of, let's say, a transfer pricing negotiation or something, that seems to me a new approach. I mean, I don't know if you would agree with that, and it seems that's
Thank you. Okay, sorry, I froze, I think, for a second there. Unfortunately, that is really all we have time for. Thank you so much for your attendance. And of course, thank you to our wonderful panel, Simon York, George, Michael Sallah, Donal Griffin, and Eric Ferron. Thank you again for all of your attendance and your questions, and thank you to the Financial Services Tax Conference 2020 for hosting us. I hope everyone enjoys the rest of the session. Sorry, we've got one more session to go, and I will be ending this broadcast now. Thank you all very much for your attendance. Thank you to our panel.
Thank you.